Hello, savvy traders and curious minds. Welcome back to the channel where we demystify the wild world of hard-to-borrow stocks and potential short squeezes. Ever wondered what makes a stock ripe for dramatic price action, especially when short sellers are involved? Today, we're diving deep into a fascinating case that's popped up on our screen: LHSW International Group Limited, trading under the ticker LHSW. We're going to break down exactly why this particular company, a player in the technology and software infrastructure sector, is showing some incredibly high cost to borrow fees right now. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. LHSW International Group Limited, or LHSW, is a Chinese technology company focusing on machine vision products and AI solutions, including facial recognition and AI behavior analysis. It's a microcap stock with a market capitalization of just $13.07 million. Looking at recent price action, LHSW has certainly been volatile. Today alone, the stock is up an impressive 10.79%. Over the last 5 trading days, it surged by a staggering 133.89%, and looking at the past 30 days, it's gained 39.96%. To chart LHSW price over 30 days, however, it's crucial to look at volume too. Today's volume sits around 559,200 shares, which is significantly lower than its 30-day average volume of approximately 4 million shares. That gives us a relative volume of only 0.1x average, suggesting that while the price has moved, current interest is quite low compared to its historical average. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? In simple terms, it's the annualized fee that short sellers have to pay to borrow shares before they can sell them. Think of it like interest on a loan, but for stocks. When a stock is hard to borrow, it means there's high demand to short the stock, very few shares available to lend, or both. This scarcity drives up the CTB fee. When you see fees exceeding 100% annually, which sounds insane, right? It means short sellers are paying daily to maintain their positions, often a significant percentage of the stock's value over a year. The higher the CTB, the more pressure there is on short sellers to either be right quickly or face mounting losses from these fees alone. Why this stock is hard to borrow right now. And this brings us back to LHSW. This stock appeared on our hard to borrow screener for very compelling reasons. Its current cost to borrow fee is an astonishing 741.6% annualized. Highlight CTB number on screen, let that sink in. Not only is it sky high, but the CTB has also seen incredible momentum, climbing by an eye-watering 644 percentage points over the last 5 trading days. This indicates a rapid increase in demand to short or an extreme tightening of borrowable shares. Speaking of which, there are currently only about 55,000 shares of LHSW available to borrow. When you consider that the estimated float for LHSW is a mere 0.1 million shares, or 100,000 shares, that 55,000 number represents over half of the entire accessible float, making this incredibly tight. Our internal composite squeeze score, which combines factors like CTB, borrower supply, and technicals, pegs LHSW a significant 64.9 out of 100. This combination of an extremely low float, a massive CTB, and limited available shares paints a classic hard-to-borrow picture. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when a stock's price goes up significantly, forcing short sellers to buy back shares to limit their losses. Here's how it works: a short seller borrows shares and sells them, hoping the price will drop so they can buy them back cheaper and return them, profiting from the difference. But if the price starts to rise, they begin to lose money. As the price goes up, so does the cost to borrow, adding to their expenses. Brokers can also issue margin calls, demanding more collateral. If the short sellers can't meet these calls, or simply want to stop the bleeding, they are forced to cover their positions, which means buying back the shares they initially sold. This forced buying creates even more demand for the stock, driving the price even higher, trapping more short sellers, and creating a squeeze. It's a vicious cycle for shorts. However, it's important to remember that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have strong conviction and are willing to pay these steep fees to stay short. Dilution risk check. A critical factor for any short squeeze thesis is dilution risk. Dilution happens when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. Niche shares can also provide an escape route for short sellers, allowing them to cover their positions without having to buy shares on the open market and drive the price up. In the case of LHSW, we've checked recent SEC filings for any dilutives -1, -3, or 424B forms over the last 90 days and found no recent dilutive filings. This is a positive for any potential squeeze scenario, as the risk of niche shares flooding the market and negating a squeeze is currently low. Recent reverse split watch. Another important piece of the puzzle for LHSW is its recent reverse stock split. Lynas Oil International Group Limited executed a 1-for-16 reverse split just 17 days ago, on June 22nd. A reverse split reduces the total number of shares outstanding in LHSW's case. For every 16 shares an investor owned, they now own 1, and the share price is adjusted upward proportionally. This significantly reduces the float, which we already noted is very low at 0.1 million shares. Historically, many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split, as the smaller float and higher share price can sometimes attract different types of trading interest. While this is a pattern observed in some microcap names, it is absolutely not a guarantee of future performance. Again, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for with LHSW? Keep a close eye on the number of shares available to borrow is at 55,000 number shrinking even further. Does the cost to borrow of 741.6% continue its upward trend? We also need to see a significant increase in volume. Remember, today's relative volume is only 0.16 average, meaning there's not much trading activity right now despite the recent price run. For a squeeze to truly ignite, we typically see volume far exceed the 4 million 30-day average. Any sustained positive price action coupled with rising volume would be key indicators. And of course, monitoring that composite squeeze score of 64.9 for any movement. Lynas Oil International Group Limited LHSW presents a truly intriguing case for those studying hard to borrow stocks with its incredibly high cost to borrow, minuscule float, and recent reverse split. It's a textbook example of a stock showing signs of extreme short interest and scarcity. But as always, this is about understanding market mechanics, not predicting outcomes. If you found this deep dive into LHSW helpful, please hit that like button, subscribe for more unique educational content, and let us know in the comments what stocks you'd like us to analyze next. Thanks for watching, and happy learning!